The S&P 500 has gone nowhere for over 11 years. Since 2000, the S&P has had wild oscillations. People talk about all the money they've made. But for buy and hold investors, it's been a rocky ride. Today, we're going to fix that. If you're listening to this presentation, it's probably because I've already talked to you about an asset allocation model that I use for equity logic. This allocation model is extremely important to me, but it's not your traditional allocation. Traditional allocation models diversify between asset classes like stocks and bonds and real estate. This allocation model is designed for equities, so stocks only. And it's designed to do something that the market cannot do on its own. It's designed to make money when the market increases. It's designed to make money when the market declines. And it's designed to beat the market handily over time. It has 3 components, and you've probably already been introduced to these. I'm not going to go into detail here about each one of these segments, but I am going to address that other question, the why. Why are all 3 parts important? Why shouldn't you just take one? The components are, first, the aggressive growth segment, which I recommend at a 15% level. Then we have a completely proactive segment. This allocation is 35%. And then we have a more conservative segment, which is a 50% allocation. Combined, the objective of this asset allocation model is to make money no matter what happens to the market, but better said, no matter what happens to the economy either. And I want to do it with less volatility. The media first started paying attention to what it was I was saying late in 2006. I issued a report called Top of the Market to You. It was issued on September 26 of 2006, and it told everyone that the top of the economic cycle was almost at hand. This was based on the investment rate, something that I hope you've all had a chance to look at. If you haven't, go to equitylogic.net and listen to the presentation on that page. It discusses the investment rate, but I can also tell you myself when we talk. The investment rate is what I consider to be the most accurate leading longer-term stock market and economic indicator ever developed. And as we continue, you'll see that it's had an integral role in all of my decision making. I was on CNBC quite a bit late in 2007, and I was talking to them about things that they didn't want to hear. I was talking to them about the impending economic crisis that lied ahead, but not because of the credit crisis, not because of the leveraged balance sheets of our financial sector, but instead about the natural changes that were happening in our economy. I was telling them that people should be aggressively short this market because the market was going to fall. This was August of 2007, and we all know what happened afterwards. The market fell like a rock. Some are going to attribute that to the credit crisis, of course, and we all know that that's the truth. If the banks didn't get in that leveraged situation, we wouldn't have those problems, at least not as severe. However, my contention is the tail does not wag the dog. In fact, the investment rate measures liquidity. And as 2007 was coming to an end, the natural rate of change in the liquidity of America was at a peak. That's what defines the cycles of the investment rate, liquidity. And in December 2007, The third major up period in U.S. history, one that began in 1981, came to an end. And the third major down period in U.S. history began. But let's be serious. The market doesn't head straight down. Even when it has these major declines, it finds legs at some point and it tries to recover. This is the natural cycle of things. In fact, the investment rate from 1900 to 2030, 2040, however long I've extended it, the investment rate slopes up the entire time with serious declines along the way. One of them was 1928 to 1938. Another one was 1969 to 1981. And this one that we're in today is from 2007 to 2023. But that doesn't mean that there won't be good buying opportunities along the way. On February 2nd of 2009, I wrote to MarketWatch, and they published to all of their readers that it's time to start getting aggressive again with stocks. The interesting part is, I issued this report to all of my clients, preparing them for this transition from bearish to bullish a little earlier than that. It was a return to parity analysis because the natural rate of change in the demand for investments within the U.S. economy was at a level that was actually much higher than where actual demand was. There was a skew. Real demand was lower than it should have been. And as a result, we were bullish. So although my words sometimes come across as doom and gloom, there are excellent opportunities to buy this market from time to time if we are proactive. And I guess MarketWatch sort of liked what I had to say, because I've been writing for them ever since. But one of the interesting articles that I wrote, which might actually surprise you, came later in 2009. That article said, let's start taking advantage of our competitive advantages, because we all have them as individual investors. We have the ability to control our risk and still make money, instead of just buying and holding and hoping for the best. In fact, if you've been doing that since 2000, on a market-based level, you've not made a thing. Proactive strategies have worked, and as the market increased aggressively from the early part of 2009, I told my clients it was time to stop being bullish and start controlling our risk in a proactive manner, using strategies that have been proven to work. Notice that this wasn't a transition from bullish to short the market, but it was a transition from bullish to proactive without being dependent on the market. One of those proactive strategies is called our swing trading strategy. And it's something that's worked extremely well for investors over time. Now, we've been doing this for over 10 years, but because we use this with QID and QLD, and those didn't come around until the later part of 2008, we only have a track record for this from 2008 on. Before that, we were using correlated stocks, offering 4 or 5 stocks per alert. QID and QLD is much cleaner. That allows us to calculate the returns of this particular portfolio over time. It's a very simple approach to the market based on technical analysis. A technical analysis that includes all markets, though, not just the NASDAQ. But ultimately, it's the NASDAQ and the NASDAQ's ability to hold support or resistance levels that make this strategy work. It's rule-based. There are inherent risk controls in this strategy. But it's not perfect. 2010, we had a down year. But from inception, compared to the S&P 500, this strategy has done extremely well. In fact, for the past 3 years, it's averaged 24.5%. Notice the beta. It is not correlated to the market at all. That makes investors very attracted to it, and it's a component that can be used as a proactive option. We're not going to sit there and let the market increase and try to fight it. But instead, we're going to let the market do what it wants to do, and we're going to take advantage of whatever it is that it does, while controlling our risk along the way. But as attractive as that is, and I really like that proactive strategy, there's a lot to be said for a conservative strategy that is able to do what our core model has done. This is our 50% allocation here. And most of you have received this. If you haven't, ask me for it. I'll send it to you by email. But when the market has fallen hard, this strategy has performed well. These green dots are the performance of the DRS strategy. The red, the S&P 500. Notice the limitation, the downside risk that exists in this strategy. It's limited, but it captures a significant amount of the upside when the market increases. Given what's happening on the monetary policy side, the constant infusions of capital are skewing what otherwise would be a very ugly economic environment, proven by the investment rate, I might add. They might be putting off the inevitable. I think they probably are putting off the inevitable. It's eventually going to come, but I don't know for sure. Maybe they continue to print money forever. If they do, I want something in the portfolio that's able to take advantage of upside while limiting the downside. And that's why this conservative part of the portfolio plays such an integral role. It's extremely important. And I know that some more aggressive investors don't think they need this. At the same time, the more conservative guys, this is all they want. But I believe in the entire model. And I think for most people, not for all, but for most people, the three parts of the model that we've talked about actually work to do exactly what it is that I want it to do. My objective is to beat the market handily, and by that, 10 to 15% I'd be happy with, and do it with less volatility than the market. With these three components, the aggressive growth, the proactive component, and the conservative one that we just talked about, I think we can achieve that goal. For anyone who looks at that asset allocation model and they balk at the idea of risk control, let me bring your attention back to what the investment rate says. In an article I wrote for Barron's, the investment rate, something that has never been wrong about predicting longer-term economic cycles, is predicting 16 lean years from 2007 to 2023. And that means a fragile market. The market is at risk. There are reasons to be concerned. And if we're talking about your wealth, then risk control means everything. And it is for you that I've produced this asset allocation model. If we were talking about some play money, it's a completely different subject. We can make money in an environment like this, though. And we do it by positioning ourselves correctly. Thank you very much.